Hello, everyone. Felipe here. Happy Monday. I hope everyone is doing great. So, as you know, I'm here to keep you up to date with current market news and teachings. This is in no way, shape, or form financial or investment advice. This is for entertainment and educational purposes only. So, I'll go ahead and jump right into what I'm currently seeing, which, as I've been talking about this for quite a while now, the semiconductor market, right? Most important commodity in the world in modern times. Why? It's in everything. It's in everything that is basically technology, and everything has some form of technology these days. Cars, you name it, every industry has some sort of influence when it comes to tech, right? So Intel recently reported its worst quarterly loss amid like a PC slump. So basically, Intel Corp suffered its largest loss, quarterly loss, and said it would remain in the red as it prepares for the market recovering from a sharp fall in personal computer sales that hammered its business. The market declined 36% from the prior year period. This is kind of like what I've been going into. In this case, is PC sales, right? PC sales, which obviously PCs have a lot of semiconductors in them and so forth. So it shows that discretionary items, or in this case, PCs, are being purchased less throughout the market, right? Which is usually the first thing people stop buying or they cut back on, right? And for example, PC sales are suffering. That means businesses are purchasing less of these items, right? And the corporations and so forth. So they're cutting back on costs, which basically means recession, right? So I look at this hypothetically in two ways, right? As it states here, sales fell to a level not seen since 2010. So the last time something like this occurred for this specific company and other companies such as Micron, it signaled the bottom of the market. However, at that time, 2010, the Federal Reserve started declining interest rates to basically a near zero level again. That is not the case right now. And the Federal Reserve is still increasing rates, and I'm speculating they're probably going to have to continue, considering inflation is still coming in hot, war is still ongoing, and now they have China as a competitor for their currency versus the US dollar, right? We're seeing a lot of countries in South America transition to use the Chinese currency instead of using the US dollar for trades and so forth. So shipment of PCs, which drive a large sales of Intel's revenue, fell 29% year over year in the first quarter, according to Intel Data Corp. That reversed the last years as people return to pre-pandemic routines. So the big bubble that occurred after the COVID crash, where everything basically had anything to do with tech literally went nuts, and stock prices went ballistic. So Intel's PC chip division reported a 38% fall in revenue for the first quarter to 5.8 billion. Here, the CEO basically states he's seeing better times in the future. However, I take what CEOs say with a grain of salt, because obviously they're going to paint their companies in the best light. And ideally, you always look for executives and CEOs that are candid and truthful, which that's rare to find. Most of them are not. And that's a red flag in any company when a CEO is being dishonest, right? The guy that's running the company is being dishonest. That's not a company you want to own. I don't know anything about this guy, but he paints it in a nice picture. However, CEO David Zinsser said the market was on the course to return to normal later this year on PC makers run through excess inventory of chips and start placing new orders. Intel sales slump translated into a $2.76 billion loss for the first quarter. Massive loss. It was the company's second loss in a row, and eclipsed what had been its largest loss of $687 million booked in the final quarter of 2017. And Intel said it would likely post another loss in the current quarter. The midpoint of the forecast came in slightly ahead of Wall Street estimates, which Wall Street estimates are always cooked. They set the estimates for earnings so low that a company literally has no other option other than to beat estimates. Estimates to me are BS, considering they set the bar extremely low to make sure companies beat expectations. And their terms that I find really annoying: better than expected, less than expected. They sugarcoat everything, which is something I really dislike that Wall Street does. So ironically, weirdly enough, market sometimes makes no sense, maybe because the CEO painted a brighter future in his words, which again are just words of someone. Basically, the day that Intel reported his earnings, one of his worst earnings ever, the company stock rose 5%. Interesting to see that. Just goes to show there's a lot of speculation in the market still. So, and here they basically state Mr. Gelsinger has moved to lay off staff and pursue other cost cuts in the face of the challenging business conditions, with a target of savings as much as 10 billion annually by 2025. This again could have influenced the stock price in a positive way. For some reason, Wall Street loves layoffs of corporations, because basically stock prices go up when companies typically announce layoffs. And it just shows again, basically how nice corporations are. First sign of trouble, they start laying off people. So a lot of awesomeness going on there, right? First sign of trouble, they just lay off people. Hey, we're laying off people. Demand for chips, which is basically what I've been saying, semiconductors, and I've been going into this because they're a leading indicator. If chip demand slows down, it means demand for other industries are slowing down, because chips are in everything. They're the most important commodity in the world. I mean, countries are literally willing to go to war over this commodity, right? As you see with China, the Taiwan issues and so forth. So demand for chips from data centers has also fallen in recent months, putting further pressure on Intel sales. The company data center division reported sales of 3.7 billion in the first quarter, down 39% from the prior year. So here we go with Wall Street terms: better than expected, less than expected. It's like I really dislike these terms because they're so sugar coated. And then of course the whole AI bubble that's going on. Any company that puts AI or mentions AI in their reports creates a FOMO, right? As we're seeing with a lot of these crypto tokens that are just putting AI in their name and suddenly creates FOMO, right? Something you want to kind of be careful with, because FOMO and all that AI talk, in my opinion, is a big bubble. So on another note, Samsung, another chip manufacturer, in this case, memory chips, big monster tech company, profit plunge 95%. That's crazy. Samsung Electronics flagged a gradual recovery for chips in the second half of the year. Its semiconductor business reported a record loss on Thursday, driven by weak demand of tech devices. They're advising basically less tech devices are selling, such as computers and other items they basically sell, right? A global downturn in semiconductor purchases amid a economic slowdown and weak customer spending sent chip prices plummeting in the first quarter, triggering production cuts across the sector. For the current quarter, Samsung said it expects limited recovery for memory chips as major data center firms invested more conservatively in servers. So a lot of these companies are basically saying that the current quarter we're in, they're expecting things to be rough again. They're basically advising, which, I mean, in this case, Samsung's being honest, which I respect that. Not a lot of companies do that, right? A lot of companies beat around the bush and BS, which that's a red flag in terms of if you own a company like that, right? You want to make sure that the insiders and executives and so forth are candid. The world's biggest memory chip maker said operating profits fell to 478 million for the January-March quarter, down 95% from 14.12 trillion won. So it fell down to 640 billion won from 14.12 trillion won, which is the Korean South Korean currency, a year earlier, and the lowest profit for any quarter in 14 years. This is not a good sign for semiconductor market, specifically memory chip market, because it's I'm saying it's a leading indicator. It's basically foreshadowing a slowdown in other industries in the near future, right? Because if less chips are being sold, less PCs are being sold, less phones are being sold, less cars are being sold, so forth. Revenue fell 18%. South Korean tech giant chip division, normally it's most reliable cash cow. So basically, these are cyclical companies, right? When things are great, they do amazing. They're cash cows. When things are bad, they do horrific. So as a result, smartphones, personal computer, server, and server companies have run down inventories, causing chip prices to plunge by about 70% over the previous 9 months. The interesting part is the stock prices for these companies are not reflecting that, which is a red flag to me. It basically shows that a lot of these companies are still selling at high valuations and the market is still in a bubble. And again, I'm speculating it's because of the whole AI frenzy, FOMO, that is going on. A lot of these companies are selling for over what they're worth or over what they're producing in terms of profits and so forth right now. Samsung made a rare announcement of a chip production cut earlier this month, joining smaller rivals, which is interesting. They made a U-turn. Samsung previously was increasing production to kind of gain market share while everyone else was cutting back. And now they made a U-turn. Just shows that things are potentially getting worse in the future if now Samsung made a U-turn from attempting to gain market share to now cutting back on production. And then this again is basically a strategy companies use to decrease supply, therefore demand levels off, right? So a balance to increase prices of these chips again, considering they have dropped in prices dramatically because inventories for these companies are building up. Despite a record loss in chips, Samsung said it spent 10.7 trillion won in capital expenditures during Q1, the highest for the first quarter of any year, which is basically the U-turn they just made. They were investing more money into production to gain market share, and they literally did a U-turn, which is interesting. And on another note, which is something I've been watching for a little while, the commercial real estate market, and I'll go into kind of like what is the issue with that. So Charlie Munger, a guy I like to listen to, very wise man, right-hand man of Warren Buffett. Basically, he's saying he's worried about the American commercial real estate market. U.S. banks were saddled with bad loans amid falling property prices. He's stating it's not as bad as 2008, but it's basically that banks in good times, you get into bad habits. When bad times come, they lose too much, right? As we've been seeing with a bunch of implosions in banks around the nation, right? A lot of banks have recently literally just gone insolvent and have had bank runs. Depositors literally flee by the hundreds of billions and by the billions, which is not good for the banking sector, right? But now with a handful of bank failures being followed by possible commercial property crash, Berkshire Hathaway, which is Warren Buffett and Charlie Munger's company, isn't getting involved. One major concern is risk stemming from commercial property loans in bank portfolios. A lot of real estate isn't so good anymore, Munger said. We have a lot of troubled office buildings, a lot of troubled shopping centers, a lot of troubled other properties. There is a lot of agony going out there. Again, the semiconductor market kind of fits in here because if less consumer discretionary items are being sold, such as PCs, phones, and other items such as that, that means shopping centers and businesses are making less money. Every bank in the country is way tighter on real estate loans today than they were 6 months ago. This kills demand. If banks are tightening and regulations are tightening, means less loans are being made. These means there's less demand for, in this example, commercial real estate. And basically what has been damaging commercial real estate is the fact that there's been a massive transition. Instead of working from offices and working from home, and that's caused a huge issue in the commercial real estate market, right? A lot of office businesses are not fully leased and they're losing money. Another one bites the dust. First Republic Bank is literally on the verge of insolvency. I would be surprised if they don't go bankrupt within the next couple of weeks. This is like one bank, next bank, another bank, they keep going insolvent. And it's a panic that seems to be spreading around because the reason that these banks are becoming insolvent is because depositors are fleeing. So First Republic Bank collapse is imminent as the FDIC works to save the troubled, I guess that's a typo there, bank. When the FDIC puts a bank into conservatorship, basically that bank is done. That bank is literally in bankrupt. At this point, the FDIC is going to run out of money because they're bailing out these banks by every other week. They don't have a limited amount of money. I mean, technically they do because they partner with Treasury and the Federal Reserve. So they're probably going to have to start up the money printer again, which is a bad time to do that considering inflation is still a problem. They didn't have this issue back in 2008. Inflation was not a problem back in 2008. So the Federal Reserve and Treasury has their back against the wall. And now, an interesting fact, China is challenging the US dollar with their currency. So it puts an additional pressure on the Federal Reserve and Treasury and so forth. So talks are continuing in the US to try to save the company and as depositors. Again, FDIC is going to have to bail out depositors and potentially the company, which then again falls on the lap of taxpayers. I get it. Treasury and Federal Reserve has money printer. They can literally fire up the money printer and print money. But at some point, considering inflation is still a problem, that's kind of bite them in the butt. So banks are a bit skeptical about taking over. So they're trying to additionally sell First Republic Bank to another bank to basically take the issue or the weight off the FDIC. Banks are a bit skeptical about taking over First Republic, a company that has lost over $100 billion in depositors in the first quarter. They recently had their earnings and they announced $100 billion in depositors' money gone. Basically fulfilling the self-fulfilling prophecy of First Republic Bank going bankrupt. Doesn't matter if a bank is financially healthy. If depositors flee, banks collapse. That's simple as that. When banks collapse, all the assets they have, because banks purchase assets with depositors' money to gain interest and so forth. That's how the banking business works. Those assets are to be sold at fire sales to meet those depositors that are withdrawing their money. First Republic's balance sheet has billions of dollars in unrealized losses that the acquirer would need to cover. So basically, any other bank or institution that plans on acquiring FRC, will have to take on billions of dollars of unrealized paper losses. And these paper losses are from long-term debt and commercial real estate, which kind of links up with what Mr. Charlie Munger was saying in the article I was just reading. So odds are commercial real estate market is going to get hit pretty viciously in the near future, because a lot of these banks that are going bankrupt own a lot of commercial real estate. And considering these banks are collapsing and they own these assets, which are currently unrealized losses, they're underwater on these loans they own, right? They're going to be sold at a fire sale. So when these assets enter the market, they're going to enter the market at fire sale prices, putting downward pressure, and on this case, on commercial real estate. When that occurs, I have no idea, but it's likely to occur at some point in the near future, considering a lot of these banks are currently going, they're collapsing basically. Here we have basically First Republic Bank's stock, absolute collapse. This thing was a crazy 214 bucks, which I believe insiders got out at this price. Nice to be an insider, right? When you have inside information, you know how to get out in time, right? And recently, as it's absolute collapse. Like, I think it's currently at like $3 a share or something. Just an absolute collapse you can see here in the stock price of a bank that has recently literally is on the verge of bankruptcy, and it's most likely going to go into conservatorship with the FDIC. So that's some of the stuff I've been seeing that is kind of freaky, right? So with that being said, I'll leave you guys with a market quote, which kind of fits into what I was saying. And I like this one. A great business at a fair price is superior to a fair business at a great price. And that is by Mr. Charlie Munger himself. And another lesson I have learned early is that there is nothing new on Wall Street. There can be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. I've never forgotten that. And that's by Jesse Livermore, who was a trader during the 1930s Great Depression. One of the hardest, most vicious depressions the basically global market has ever seen. So with that being said, thank you guys for watching. I hope I shared some valuable information with you today, and I'll talk to you guys soon. Have a good one.